Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. And today we're looking at CXApp.
Yeah, and if you find our talks useful, please consider, subscribing, liking, and commenting underneath. So to kick things off, have you ever walked into your office expecting that completely seamless, frictionless productivity you see in commercials?
Oh, right. The perfectly lit, totally empty office ads.
Exactly.
Yeah.
But then reality just hits you in the face the second you badge in. You know the exact feeling I'm talking about.
I mean, we all do. It's universally frustrating.
Right. You're toggling between like 5 different fragmented apps just to find out what floor your team is even sitting on today. Or you're trying to book a hot desk that the system says is totally available, but when you get there...
Someone's backpack is already sitting on the chair.
Yeah. Or you spend 10 minutes wandering around looking for a huddle room that is supposedly free, but it actually has 3 people in it taking a loud Zoom call. It is just the absolute definition of spatial friction.
Yeah, it's workplace whiplash, really. We're living in this very strange transition phase of work culture, and the software ecosystem has just severely lagged behind the physical reality of how we actually use corporate buildings today.
And that massive disconnect is the foundation of our analysis today. We're exploring the frontier of what the tech industry calls spatial intelligence.
Which is a fascinating space right now.
It really is. And to do this, we're looking through the lens of a genuinely interesting, kind of under-the-radar software company called CXApp.
Yeah, the data on this one is incredibly compelling.
It is. We've got a great stack of research for this, ranging from daily market volatility reports and SEC filings to some really technical analysis on their patent portfolio.
It makes for the perfect case study, because when you look at the raw data in these reports, you see a company attempting to solve, one of the most universal headaches of the modern workforce.
All right, so our mission today is to sift through all this and figure out if this tiny company is actually building an impenetrable, multi-million-dollar technological moat, or, and this is the big question for wealth building, if it is just a speculative small-cap tech bubble waiting to pop.
Because the stakes are high. To really understand it, you have to think about navigating a massive, sprawling, totally unfamiliar city without a smartphone map.
Oh, that sounds like a nightmare.
Right. You might eventually find your destination, but you're going to waste a ton of time, ask a bunch of people for directions, and arrive incredibly frustrated. And, well, CXApp is attempting to build that smart map plus a brain for the modern corporate workplace.
The brain element is key, though, right?
Yeah, exactly. That brain element is what separates their platform from just like a static digital blueprint. They aren't just giving you a PDF floor plan on your phone.
Which wouldn't be very helpful anyway.
No, not at all. They're building a live AI-powered spatial intelligence ecosystem.
Which brings us to the core tension we really need to unpack. The data paints a picture of this fascinating duality.
A very extreme duality.
Yeah. On one hand, we are looking at a company with massive global enterprise clients, deeply embedded technology, and, cutting-edge patents.
But on the other hand,
Simultaneously, their stock chart looks like an EKG machine during a panic attack, and they are battling a very literal ticking compliance clock right over their heads.
yeah, it's wild. If they've genuinely built this impenetrable tech moat, you would expect their valuation to be incredibly stable.
Right. Instead, the market is treating them like a lottery ticket.
The divergence between their actual operational footprint and their market perception is just stark. To understand why that gap exists, we have to look at how they are actually operating behind the scenes.
Because their business model completely defies typical corporate scaling logic, doesn't it?
It really does. I mean, looking at the workforce breakdown in the research, CXApp operates with a remarkably lean team.
How lean are we talking?
We are talking about just 80 people.
Wow, only 80.
Yeah, just 80. But the critical detail is how those 80 people are deployed. A massive 66% of them, so 41 employees, are dedicated purely to research and development.
That ratio is just a massive signal to the market.
Huge signal. It tells you they're not interested in building some bloated sales army. They are building an engineering fortress. They are pouring their capital straight into the product itself.
And despite having fewer employees than, like, your local grocery store, they are deployed in over 50 countries and across more than 200 cities.
It's a crazy footprint for that size.
Totally. The filings show they're serving over 20 Fortune 1000 customers. And we aren't talking about agile little startups that are easy to sell to.
No, these are massive clients in highly regulated, notoriously sticky sectors. We're talking financial services, big tech campuses, healthcare systems.
Locking in those specific types of clients with such a small team That basically comes down to the concept of the tech moat, right?
Precisely. Specifically, incredibly high switching costs and network effects.
So let's actually look under the hood of that tech moat, because the research mentions some very specific proprietary jargon.
Right, the acronyms.
Yeah, they talk about a BTS engine and VU analytics. To the average employee, this just looks like a standard booking app on their phone. What is actually happening in the background?
Well, think about standard GPS technology. It completely fails when you walk inside a massive steel and concrete building.
Well, sure, you instantly lose the signal.
Exactly. So CXApp built this proprietary tech, their BTS engine. Think of it as the nervous system of the corporate building.
Okay, so how does it work without GPS?
It utilizes Bluetooth, low-energy beacons, and Wi-Fi signals bouncing off your smartphone to pinpoint exactly where you are standing in real time, indoors.
So it's basically indoor triangulation.
Yes. And then they feed that live positioning data into their VU analytics platform. This is the visualization layer.
Ah, okay.
Suddenly, the employer isn't just looking at a static map of desks. They are looking at the living, breathing traffic flow of their entire workforce.
That is fascinating.
They can see which zones are overcrowded, which conference rooms are perpetually empty, and, how teams physically interact throughout the day.
So management gets a real-time heat map of their real estate utilization, while the employee just gets turn-by-turn navigation to find their team.
Exactly. It serves both perfectly.
But, a map alone isn't a moat. The reports highlight that they have over 100 enterprise tool integrations. That seems to be the actual glue holding this all together.
Oh, the integrations are everything. Think about it. A Fortune 1000 campus already uses dozens of different vendors.
Right, like a security vendor for badge access.
Yep, and an IT vendor for help desk tickets, a communications vendor for internal messaging, a scheduling vendor for calendars.
It's a mess of apps.
And CXApp takes all 100 of those fragmented tools and funnels them into this single AI-powered spatial map.
Which effectively makes them the operating system for the building itself.
That's the perfect way to phrase it.
I mean, if I'm a hospital administrator and I've integrated my secure door access, my room booking, and my nurse ticketing system directly into your map, the friction of trying to rip you out is astronomical.
It's nearly impossible. The switching cost isn't just buying a cheaper competitor's software.
Right, I would have to untangle 100 different vendor APIs and retrain 10,000 employees who use your map every single morning.
Exactly. The friction of leaving becomes vastly higher than the cost of staying. That is how you achieve category maker status.
You make yourself indispensable to the daily physical operation of the company.
Bingo.
I marvel at that level of scale, but I have to push back a little on the vulnerability here.
Go for it.
We established this is an 80-person company supplying the core physical operating system for 20 global Fortune 1000s. To me, that sounds like a massive operational risk.
How so?
Well, what is stopping a trillion-dollar tech giant, say Microsoft or Google, who already own the enterprise suite, from simply dedicating 500 engineers to copy this indoor mapping system and rolling it out for free just to crush them?
It is the existential question for literally any microcap software company. And the defense against the trillion-dollar giants relies entirely on intellectual property.
The patents.
Right. This is exactly where that 66% R&D headcount pays off. They reinvest their capital heavily into IP. The tech analysis shows they have filed 37 patents, with 17 of them already granted.
So they basically built a highly specialized patented mousetrap. They've patented the spring, the base, the cheese, and the exact way the mouse steps onto it.
That's a great analogy. Sure, a giant like Google could certainly try to map the inside of a building.
But navigating the specific patented integration.
Exactly. Replicating the on-device positioning and spatial analytics that CXApp has locked down creates a legal and technological minefield.
A minefield that a larger company would probably rather just acquire than try to litigate or build around from scratch?
9 times out of 10, yes. Acquisition is cheaper than a massive patent war.
Okay, so that sets up an incredible paradox. If they have this impenetrable patented mousetrap, and they are deeply embedded in hospitals and banks across 50 countries, why is their stock acting like a volatile meme coin?
That is the million-dollar question.
I mean, looking at the trading activity reports from March 5th through March 13th of 2026, this company was constantly flagged on lists of information technology stocks moving.
The hyperactivity in their order books during that window was just staggering.
They were hitting pre-market lists, intraday lists, gap up lists, gap down lists.
Just bouncing everywhere.
Right. But the research explicitly notes there was absolutely no recent insider cluster buying. There was no massive institutional accumulation filing that dropped. There wasn't even a surprise earnings beat.
Nothing fundamental changed in that week.
Exactly. And the cash management is implied to be quite tight. So what is actually driving these massive daily swings if the business itself hasn't changed overnight?
You are witnessing the classic divergence between fundamental business growth and algorithmic momentum trading.
Oh, the algorithms.
Yeah. To understand those daily gap up and gap down lists, you have to zoom out to the broader macroeconomic environment. In the small cap tech space right now, stocks frequently get swept up in sector rotation.
So a day trader or an algorithmic trading bot sees the stock moving on a pre-market screener, and it triggers this like psychological feedback loop,
Precisely. They buy the momentum, assuming someone else knows something.
which just generates more volume, pushing the stock onto yet another momentum list.
They are buying the category, not the company. When macroeconomic hopes shift, for instance, when the market anticipates interest rate cuts, which historically benefits speculative growth, tech traders start aggressively hunting for low-float small-cap stocks with an AI label attached to them.
It's a hype train running on a very bumpy track.
That is exactly what it is.
The passengers are getting violently shaken around, but the movement has absolutely nothing to do with the actual destination of the business. The market isn't trading their 17 granted patents or their Fortune 1000 footprint.
No, not at all.
It is trading them as a speculative AI lottery ticket based on daily volume algorithms.
And, in the short term, the market functions purely as a voting machine, driven by immediate flow, sentiment, and sector hype.
But in the long term,
In the long term, the market is a weighing machine. Eventually, the fundamental weight of those enterprise contracts and those patents has to materialize in their actual revenue and earnings trajectory.
and if that cash flow doesn't show up,
Then the momentum algorithms simply abandon the stock and move on to the next shiny object.
wow. And that tension between a fast-moving stock and slow-moving cash flow, that brings us to the most quantifiable risk hanging over the company right now.
The bridge that's out ahead.
Exactly. Because they aren't just dealing with a bumpy track, there's a very real ticking compliance clock.
Yes, the overarching news sentiment surrounding the company and the reports is perfectly neutral, but buried in those March filings is a massive, massive catalyst.
Right in the middle of that crazy trading window, on March 12th, they received an official 180-day compliance period extension to regain their NASDAQ listing,
Which is a huge deal.
meaning they have until roughly September of 2026 to get their stock price and filing requirements back above NASDAQ's minimum thresholds.
The threat of delisting is the ultimate shadow over any microcap company.
Walk us through the mechanics of that threat, though. If they build great software, why does it matter so much if they just drop off the NASDAQ exchange?
Because of how capital flows.
Yeah.
If a company loses its NASDAQ listing and falls down to the over-the-counter markets, what people often call the pink sheets, it triggers a catastrophic chain reaction for their capital.
Really? Just from moving exchanges?
Yes, because many institutional investors, pension funds, and major mutual funds have strict internal mandates that legally prohibit them from holding unlisted over-the-counter stocks.
Ah, I see. So the moment they get delisted, those massive institutional holders are effectively forced to liquidate their positions.
Exactly, which completely crushes the share price.
And worse, I imagine it completely dries up their ability to raise new capital to fund that 41-person R&D team.
Capital becomes incredibly expensive and highly toxic when you are off the major exchanges. The liquidity just vanishes. So that 180-day extension they secured in March is nothing short of a lifeline.
The analysts assign the company a 6 out of 10 bullish score, which really feels like cautious optimism balancing on a razor's edge.
It's a very fragile balance.
But it highlights an incredible paradox at the heart of their business model. It almost feels like they are suffocating under the weight of their own massive clients.
That's actually a very accurate way to look at it.
Right, because if their spatial analytics are truly revolutionary and they are already deployed in 50 countries, why are they starving for the cash flow needed to maintain a basic NASDAQ listing?
Because enterprise software sales are agonizingly slow.
How slow?
You do not just walk into a global financial institution or a massive hospital system and simply swipe a credit card for a new operating system.
The friction of procurement.
Oh, the friction is immense. First, you have to win. the request for proposal. Then, because your software requires mapping the exact physical locations of their employees and integrating with their security badge
Oh, the
systems.
security audits.
Exactly. You have to pass a rigorous 6-month cybersecurity audit.
Wow.
Then comes the pilot program on a single floor, then the legal negotiations, then the phased global rollout.
That takes forever.
That entire cycle can easily take 12 to 18 months before a meaningful check is ever cut.
And while you're waiting 18 months for that Fortune 1000 check to clear, your 80-person company is still burning through capital every single payroll cycle.
That right there is the core of the 6 out of 10 score. The bear case is glaringly obvious. The delisting risk is severe, the enterprise sales cycle is bleeding their cash reserves, and the opaque financials lead to these wild, unpredictable momentum swings.
But the bull case is that this 180-day NASDAQ extension is the exact amount of oxygen they need.
Yes. They're basically betting that the long-term permanent shift to hybrid work, combined with the sector-wide rotation into tangible AI applications, will provide the wind at their backs.
They just need to survive long enough for that agonizing enterprise sales cycle to finally hit its revenue inflection point.
They have built the ultimate patented smart map. Now they are just waiting for the traffic to pay the toll.
It is a classic race against time. The technological moat is already dug. The financial stabilization is what the market is desperately waiting for.
That's exactly it.
So, bringing all these threads together, what is the ultimate takeaway for you, the listener? If we had to distill this entire analysis into an elevator pitch for your wealth-building strategy, it looks like this.
The high-risk play.
Absolutely. CXApp represents a high-risk, multi-year hold. It is a calculated bet that their deeply embedded tech moat, those 17 hard-fought patents, and their incredibly sticky Fortune 1000 footprint will eventually outweigh the sheer volatility of being a small-cap stock.
You're betting on the fundamentals eventually catching up to the tech.
Right. It is a bet that they can outrun that ticking NASDAQ compliance clock before September 2026 and successfully translate their brilliant R&D into real, scalable platform monetization.
It requires an investor to look way past the daily momentum lists and focus entirely on the structural shift in how corporate real estate is managed.
Tomorrow, when you walk into your office or your co-working space, take a hard look at the digital friction around you.
Notice all the annoyances.
Yeah, notice how many different apps and key cards and portals you have to use just to accomplish the basic task of sitting down near your team. Think about how much more efficient that building would be if one invisible, integrated spatial platform simply mapped it all for you.
The demand for the solution is undeniably there. The friction is universally felt.
But before we wrap up, there's one final, really provocative angle hidden in this technology that goes far beyond stock prices and patents. Something to chew on during your next commute.
Oh, the privacy angle.
Yes. If an AI platform truly becomes the unified operating system of a physical corporate building, if it relies on Bluetooth beacons to track the exact on-device positioning of every single person.
Mapping their spatial movements, who they stand next to, how long they spend in the break room.
Exactly. Who ultimately owns the rights to that spatial data?
It is completely uncharted territory for corporate data rights.
Is it the employer who is paying millions of dollars for the software license to optimize their expensive real estate footprint? Is it the tech company itself who built the algorithms and mapped the proprietary grid?
Or does it belong to the people?
Right. Does that movement data, the physical reality of a person's actual presence in a space, belong to the employees generating it? We started today talking about the annoyance of finding a desk in a disorganized hybrid office.
But the solution has a cost.
It does, because the solution to that friction requires the implementation of an all-seeing, continuously tracking smart office. And figuring out who controls the map of our physical working lives might be the most valuable and complicated puzzle of all.